Binay Chandgodia, Portfolio Manager at Principal Global Investor, joins us on the show from Hong Kong now. Good morning, Binay. The political leaders have reached a deal in Greece. How do you view these developments?
Yes, they've reached a deal in Greece, which is a positive for the markets because it takes out a constant source of uncertainty in the marketplace. Having said that, between the time that they approve the deal and they present the actual budget and they implement it, there's still going to be a lot of kind of, uncertainty there. So while it's a good step, it's not the end of the Greek saga. We're still going to see headlines coming out of Greece in the next 1 or 2 months about how they go out and implement the package, about what form they give the commitment to the Troika about implementing the package. The issue here is that all parties need to sign on that document which says that, okay, their commitment to these cuts, to these reforms is independent of political identity. And that is where I think you could see a little bit more of uncertainty going forward. But by and large, yes, it sets Greece on a path where they can honor their second round of, where they can honor the bond payments due in March, where they get the second round of funding from the Troika, and where the PSI participation can start taking place now.
Binay, what's your view on the US where there is talk of QE3? What data point will you be monitoring in the US to signal a conclusive recovery?
Well, we are not big supporters of QE because we believe that while it does put flows into the system, it also kind of creates a headache in the form of higher potential inflation. You just look at oil prices and how important oil prices are in a global context where consumers have to pay for that increase in oil prices. So, I mean, our sense is that it's not going to be a great thing if the US does a QE3. Having said that, looking at the Fed tone and the tone of the Fed chairman at the last meeting, it seems like there might be some injection of money in the housing sector. They might do something on that if housing data worsens from where it is today. But by default, I don't expect them to do it. But yes, if things get worse, they will.
Well, Binay, the dollar index is sub 80. What's your view on the dollar in the near term? Do you see the rupee in the first half to strengthen versus the dollar?
Well, it's like it's getting very interesting actually between US dollar, euro and Japanese yen. You look at all three big central banks, actually even including British pound, because all four central banks are on a fairly sizable overt or covert quantitative easing path. Bank of England raised their asset purchase target last week. Fed, has been increasing its balance sheet size significantly, and ECB has been the master of them all because their balance sheet size increase was quite significant last year, and with the next round of LTRO likely to take in a substantial amount, that will go up further. So, dollar on that basis relative to euro and the Japanese yen, I think it's going to be dependent upon growth ultimately because all three are embarking on a quantitative easing cycle. But yes, if growth remains solid, it means that the emerging market currencies, Asian currencies, the Japanese yen should appreciate going into the later part of this year, especially if growth holds up nicely.
Right, and what's the view on India and China after the rally we've seen so far? Now, most believe the rally has been speculative. Would you agree with that? And are allocations of serious long-term capital increasing in favor of the region? How does India stack versus other emerging markets on valuation?
There are some signs about some changes at the margin in both India and China on the policy-making front. India especially, they've done a fair bit to restore investor sentiment, like increasing the limit on FII debt purchases by $10 billion, by allowing overseas citizens to invest into India directly. There have been other signs like RBI going out and telling that, okay, the next move is going to be a cut in interest rates, not an increase in interest rates. So at the margin, this has helped restore some sentiment. At the same time, RBI has been doing a lot of open market operations to inject liquidity into the system, and they also intervened apparently in the FX markets to control the slide in the Indian rupee. So that has injected some optimism at the margin for India. Having said that, the critical thing that we see for India is the massive fiscal deficit and the massive current account deficit. We think unless these are addressed in the budget, in the forthcoming budget, the optimism on India could fade away soon. On the other hand, in China, I think the main reason for optimism was, China was, I guess, relatively underbought. It was oversold, very cheap valuations, and of course the signs that the Chinese policymakers were willing to take the foot off the tightening pedal. Now, there was just one RRR cut in China, but you see that they've been trying to loosen policy in selected sectors where tighter policy was hurting the economic growth. So China is, again, a play on the margin, at the margin on A, valuations, and B, on the fact that the macro environment could get better as we get into the second quarter of this year. I mean, there are some analysts and economists who factoring in more RRR cuts going forward, and that could be positive for the banking sector because it's a very credit-driven economy. And if credit controls remain very tight, then obviously it has a negative implication on the generic Chinese growth.
When the rupee has been appreciating versus the dollar recently, how much more appreciation do you see as far as emerging market currencies are concerned? And in the EM versus DM trade, what return expectations are you working with?
Well, I guess that'll depend upon how economic growth holds up. Right now we are on a risk-on environment. We've been since the beginning of the year, so which is positive. And if you look back at history, then equity market performance in emerging markets tends to gel well with a currency performance as well. As in, when equities do well, currencies also appreciate. So, I mean, from that perspective, the critical thing here is no more mishaps in Europe. There will be disturbances in Europe, but no more mishaps. The U.S. economic policy staying fairly loose as it is today. And of course, China continue to grow at 7.5% to 8%. I think if this environment maintains for the rest of the year, you would see more flows getting into emerging markets, and that should be positive for emerging market currencies. So they could appreciate 3 to 5% this year.